the payroll recession is still very likely in the US. So the 80% of the economy related to the service sector will likely struggle into next year as a consequence of rising input costs from labor relative to what they're able to get for their products.
Hi, everyone. Welcome to the second installment of our special series, Crash or Boom, How to Profit from What's Coming. So Raul kicked things off with his overview of what he expects over the next 8 to 10 months. And not surprisingly, he's bullish. He thinks the recession that everyone's been waiting for is already here. It already happened and may actually be ending. He's not worried about inflation. Instead, the big issue for Raul is the ballooning debt and the government's need to finance it. That debt dynamic is core to his belief that tech and crypto offer the best opportunity in the next year. But we got some pushback in the comments, as we expected. William M. pointed out that Raul may be in the minority, and many of you raised issues about commodity prices and the impact of China, to name just a few. So to drill down on some of these points and give us their view on crash or boom, I'm joined by my colleague, Andreas Steno Larsen, and Mikael Sarwe. Andreas, take it away.
Thank you so much, Maggie, and great to see you as well, Michael. You recently wrote a piece called The Plot Thickens, and it relates to the discrepancy that we've seen between the gross domestic product and the gross domestic income in the US. One is pointing to a recession, the other is pointing towards maybe even above trend growth at the current juncture. So what do you make of this crash or boom question initially here? Are we already in a recession?
Yeah, it's a very interesting question, and there are indicators that point that way, I would say. However, of course, markets and economists tend to follow GDP numbers and unemployment numbers, and they're not there yet. And the debate on the gross domestic income versus gross domestic product is an interesting thing in that sense, given that normally those should basically be the same, and right now they're not. If we look historically, it's been the case that, for instance, in the financial crisis, you saw a weakening in gross domestic income before GDP. So it was a leading indicator back then. It was also a leading indicator, I would claim, in the early 90s. And it rhymes a lot better with many of the other indications of a recession. As you can see in the senior loan officer survey, with credit tightening a lot, you can see it in filings of bankruptcies piling up in the US. You can see it nowadays also in job openings falling quite severely in the US, with layoffs at the cyclical high and so on. So to me, it is an indication that maybe GDP numbers are overstating how good the economy is doing right now. And as I said, it has tended GDI to be a leading indicator in the past.
Michael, in full transparency, you are my former boss from Nordea Bank, and we've worked together on building macro models throughout the years. And I sincerely think that you have the best model package on earth when it comes to forecasting gross domestic product developments across the globe. So if we look at your GDP model for the US right now, it basically screams recession, doesn't it? I think we can get it up on the screen here.
Yes, it does, and it has been doing so for a while. And if we look back in the past, basically, it has historically never been wrong when it's pointed to recession. We, of course, also know that GDP numbers, and for that matter, labor market numbers as well, they are a little bit difficult at turning points. There tends to be quite large revisions. So we'll see how this plays out. I mean, I tend to follow my models very closely, and right now it's clearly so that the US one has been wrong. But on the other hand, if we look at sort of my Swedish one or my European one, they are continuously spot on in terms of pointing to recession. So I guess the plot has thickened.
Yeah, it has indeed. And if you look at the current discrepancy between your model and the actual outcomes in the gross domestic product in the US economy, are there any reasons to sort of believe that the US economy is resilient relative to what we've been used to and what the model sort of used to forecast based on?
Yeah, I mean, of course, you should also always think that your model can crash, and there could be periods where other factors are important. And I guess one thing right now that could be of importance is both the old stimulus checks from COVID, how much money actually was left of those heading into 2023, and then secondly, in some sense, also the Inflation Reduction Act and kind of the policy effects from that. Those are two reasons that maybe means that the economy is moving along more smoothly than my indicator is pointing to. And on top of that, I guess if you add a little bit of what I've been calling the nominal illusion, in terms of looking at other economies, that we see that volumes are falling in many countries in terms of industrial orders and so on. It's not true for the nominal side because of inflation. And of course, companies has a bottom line which is nominal, and as long as the bottom line looks okay, I think perhaps that is another explanation why it drags on this time.
Hey, sorry to interrupt again. It's Raoul here from Real Vision. I'd love for you to subscribe to the channel, get the notifications. We have so many incredible conversations with so many amazing people. It will really help you in your financial journey and your journey to understand just what the hell's going on in this world. Anyway, click subscribe, get the notifications, and enjoy.
I can actually bring up a chart on that exact effect from the Inflation Reduction Act. I've relabeled it to the Inflation Refueling Act instead, watching the developments in the US economy right now. It's a chart showing the construction financing across various subsectors in the manufacturing sector. It's chart number 3. And the financing for manufacturing construction is basically through the roof over the past, say, 8 to 12 months here, likely as a consequence, among other things, of the IRA and also the Chips and Science Act. So without that stimulus from the public sector, would the US be in a recession right now? Is that a fair assumption to make, Mikael, based on the deficit that we see in the US now compared to peers as well?
I would guess so. That would be the case. Then I guess another point to make here is that I guess as many have pointed to as well, we have a housing market where the existing home sales market is more or less dead because you basically can't move, can't afford sort of higher interest rates. On the other hand, it's still the case that the interest rate on the outstanding stock of mortgage loans are quite low. So in normal circumstances, rate hikes of the significance we see now should have started to affect the economy, but it seems that it might be a longer lead this time. Of course, normally, if you take monetary tightening and look at the maximum negative effect on any economy, it tends to be sort of 1.5 years out in time. And of course, the Fed was still hiking rates fairly recently. So I would still think that the lagging effects of the monetary policy tightening will be with us far away into 2024, in my opinion.
If we look at the cyclical components of the US economy relative to the stickier components in, for example, the service sector, in the leisure sector, in the healthcare sector and stuff like that, where do you find the manufacturing versus the service sector to be at this juncture in the US economy? I know you have a tremendous chart on truck transportation, chart 4, that we can bring up in this discussion.
Yeah, it is. I think in general, looking at various type of labor market data, clearly it's been the case, and clearly that's been the case since after the COVID problem started to disappear, that there's been a shift back to services, clearly, after the huge increase in more goods consumption before that. And clearly the labor market has also been continuously strong. However, there are a lot of indicators, cyclical indicators of the labor market where we're starting to see a change. This is a truck transportation cost. Clearly it's affected by the yellow bankruptcy, but still it tends to be a very clear cyclical indicator when employment here starts falling. The same is true with temp jobs that we've seen falling now for a number of months. So looking at these indicators and looking at kind of the service versus good side and kind of the ISM and ISM non-manufacturing, if you want, it still looks like services are keeping up. However, with the monetary tightening, I would suspect that those things are now turning the other way, while perhaps the manufacturing cycle, looking at the ISM, could be bottoming at some point here. And what the net effect there will be for markets is quite tricky to say. I would say still, of course, if you look at the service sector in the US, it's like 85% of the economy. So if that slows down the way I expect, that's an effect of higher interest rates and kind of cash flow effects on that down the line, then that will be more important. But markets often have a tendency to look a lot at manufacturing data as well.
Mikael, you're obviously based in Stockholm, Sweden, and I guess Sweden is one of the most interest rate sensitive countries on earth. I think that's fair to say, also given the exposure to variable interest rates in mortgages, etc. So as international investors, is there anything that we can learn from the developments that we've seen in the Swedish economy, say, over the past 1 or 2 quarters here?
Yeah, I think so. I mean, it's been so in the past that Sweden has relatively often been a little bit of a canary in the coal mine for the global economy. So when Sweden is running into problems, which we have been doing now for a while, then it's usually an early sign that you'll see other parts of the world going the same way, kind of like Germany is doing now, and what have you. And of course, one part of that is the small open economy that Sweden is, which with a large export sector that fairly early picks up on trends turning either positively or negatively. And then the second part is what you alluded to, which is households having higher debt here than elsewhere, and a lot of variable rate loans, particularly on the mortgage side. So when we see rate hikes here in Sweden, it tends to affect the house prices quite directly, and house prices then leading to also affecting consumption. So of course, what we have been seeing in Sweden is a clear slump in personal consumption over the past year or so, and in retail sales. And what we now is seeing is basically a full stop on more the construction side, where building permits have plummeted, and we now see clearly a much lower activity. On the export side, I think also it's important to note that Swedish companies that are helped by a very weak currency still now see in various business services that the order intake, the new order intake, is deteriorating quite rapidly, while they still have fairly good order books with old orders, basically stemming back from the COVID years. So I think the fact that Sweden is in a recession and will continuously be in a recession into 2024 is, to me, an early sign that the rest of the world will follow.
I think we can bring up a chart on that exact new orders survey from Sweden. It's chart number 6, and it doesn't look pretty, to say the least, with recessionary vibes since late last year, and obviously also given the forward-looking nature of this survey, with recessionary vibes into next year. If you look at the German economy, obviously one that is tracked by many also in the US, Mikael, what do you make of the current state of affairs in Germany and the recession risks in the Eurozone overall? Are we already there?
Germany, I think so. I mean, unemployment bottomed, I don't know exactly, but maybe 6 months ago or something, and has increased since. GDP is negative in Germany year over year, even though it's a small negative. I guess the whole euro area isn't really there yet, but clearly Germany is. And of course, in Germany, we see similar signs as in Sweden, but with a little bit of a lag in terms of the real estate market moving into problems. And also here nowadays, building permits plummeting in a way that basically is telling us that construction will be basically dead for 2024. So Germany is really following a lot of what we're seeing in Sweden. We've seen quite weak order numbers out. The IFO that started to bounce up as the energy crisis was getting less severe has now turned down again. following, I would say, once again, the monetary tightening rule book, i.e. with kind of 1 to 1.5 years lag, or rather 1.5 years lag, you should expect the monetary tightening to hit the economy and particularly start to hit the service sector, which we're also starting to see now in PMIs around Europe.
Yeah. One of the key themes in our campaign over these 2 weeks is how to profit from this crash or boom binary scenario, Mikael. And I received the latest copy of Bank of America's fund manager survey today. They conduct this survey among money managers each and every month, and they, for example, ask the managers for their current positioning relative to benchmarks. And I noted that Europe is truly out of fashion again in this survey, while the US is among the top picks. So when we talk about the US economy being more resilient than Europe, it may already be priced in, at least if we listen to this fund manager survey. So what do you make of the positioning also with your sparring partners in Northern Europe? Is the US still the consensus long story out there?
I think so, and I guess talking about Europe and saying it's easier to have people believe in you when you say that Europe is heading into recession compared to saying the same about the US, and I think that also is clearly what you see in positioning, and of course Europe. If you look at forward PE on the median company in Europe and the median company in US, trying to scale away these magnificent seven. Then Europe is looking cheap, very cheap compared to history. But of course, the reason is that everyone believes that, or most believe that Europe is in a recession, while almost everyone believes that the US will not be. And then you end up with that type of position and that type of relative valuation in a sense. And then I guess what I'm saying is that I expect the US to follow Europe down into recession, and then this quite large valuation difference compared to history perhaps looks too large.
Yeah, fair point, Mikael. And where does China rank in all of this? I went to the US, was it 3-4 months ago, with my front page of the slide deck stating that Chinese assets are the cheapest on earth. And there might be a reason why they're the cheapest on earth, but how do you rank China in all of this? Also, given what's ongoing in Chinese real estate?
I mean, looking at China and sort of my view was heading into 2023 that when we were starting to see this reopening story, that would falter, which it to some extent has done now, partly because of the property market and the real estate market, and very much for domestic reasons. But I guess also in a sense, which you can see now, and that is that imports from China to the US has basically slumped, which seems to be at least partly a political story, I would assume, which means that to my mind it would be difficult to sort of believe in this reopening story fully, and I guess now that has turned out to be true at this instant. I mean, that doesn't mean that things will continue to look that way. And of course, now we're seeing a lot of measures being taken. So I've been cautious about China, which has been correct in a sense. But now everyone is getting very bearish, on the other hand. So maybe I think it's time to scale back on that bearishness and hawkishness because of everyone else. And I have to note that what we've seen recently is the Bank of China adding a lot of liquidity through their open market operations. And when we've seen that in the past, it has at least temporarily created a cushion for the equity market, and equities have tended to go up a little bit during those periods in China. It has a very strong link between what the PBOC is doing with these open market operations and the stock market. So that makes me a lot less negative than I was if you go back 3-4 months on it. And we'll see about that.
If we look at the current price developments in oil space, in particular, but also in broader commodities, we've seen a tendency towards higher prices over the past couple of months now. and it may be related to a rebound in China. We're not fully sort of certain of that story yet. But what do you make of this spike in commodity prices, given that we are, if not amidst it, and at least on the verge of a recession around the West?
No, it looks a little bit odd, I have to admit, and particularly with my more negative tilt. But of course, prices are what they are, and oil prices are booming here. And it's also a little bit different to see in terms of the balance of demand and supply right now on the oil market. But so whether how much this is speculation or not, we will see. But it clearly doesn't rhyme fully with my more negative tilt. However, of course, my negative tilt is right now more tilted towards kind of service sectors and consumption sides of the economy, perhaps rather than the manufacturing side. But anyway, so it looks a little bit odd. But I guess and a sort of side effect of it will likely be that right now, when a lot of investors and a lot of economists are expecting that we basically have passed the peak now in terms of Fed funds target rates, and for that matter, I guess the same is true what the market is counting for the ECB. I guess this is something that could change that, because what will happen now is, of course, on the back of this increase, we will see all the classic price components of ISMs and PMIs shooting up again, and perhaps shooting up quite markedly. And that is something that normally, I guess, the bond market and central banks do not like.
I had a tremendous discussion with Hugh Hendry, the former hedge fund manager at RealVision, a couple of months ago on how to tail hedge for a recession in the US. And he was of the view that calls on TLT, so the far end of the yield curve in the US, made sense also from a price perspective at the point if you wanted to hedge yourself against that recession risk. But given the price spikes that we see in oil space, given the lack of true progress towards that 2% inflation target, can one hide in bonds into such a recession in the US here, Mikael? Is it as safe bet as it used to be?
It's less safe. Let's say it like that. And I would have agreed with him. And I mean, if I go back here and you know, think about what my focus was then, I back then guessed that by now we would be more clear that also the US was entering a recession, and that would lead to a clear bond rally. However, as time has progressed, I've come to the conclusion that that's probably too early, which it has been so far. And clearly now, a lot of my leading inflation indicators, and you know a lot of them, I mean, they're not looking as benign as they did before. I have a US CPI model that looks, 6 months out or something, and for the US, and basically it picked the development very well on the way up and very well on the way down. Now it's saying that it's not going to improve anymore. We're going to have US CPI at above 3% also the early parts of next year. And that makes, of course, a more difficult situation if you want to be a bond bull. Clearly, at the end of the day, however, if we get a more severe recession, that will definitely seal the deal for bonds, I think. But for now, what I've been saying since before the summer is that the risk and sort of the trend for the bond yields would continue to be up, because central banks are quite clear with the idea that whatever happens in terms of where the peak is in policy rates, rate cuts are very, very far away. And as that is such, and then looking at today with all the inflation indicators, perhaps signaling that it's not going to be as easy to get inflation down next year, then you end up with the risk that we should see new highs on the US 10-year yield again here before, if I'm right, there's a recession scenario comes into play, perhaps around year end or something.
Yeah, I basically lean the same way. And earlier today, we got the monthly survey from the NFIB, basically a survey conducted among small and medium-sized companies in the US, 80% services-based-ish, and the price plans ahead actually re-increased in the survey again.
Yep.
So when they look 3-6 months ahead, the CEOs of these small and medium-sized companies, they actually expect both compensation of employees and price plans to be a tad higher than they did just a couple of months ago. It may be related to the commodity price spike, but it basically rhymes with what you're saying, Mikael, that we will get at least a local bottom clearly above 2% in US inflation. So in relation to the market pricing right now of the Federal Reserve, no one believes in a hike here in September, but there's still, I'd say, a decent chance priced in for another hike this year, but then next year, cuts, right? So what do you make of that cocktail? Is it too early to price that all of that in, given the recession risks?
I think so, and I think what we will continue to hear from the Fed, and for that matter from the ECB, is that they will disagree with the discounting of rate cuts next year, and basically sending the signal that 2024 we will be on hold, and so we need to see a lot more evidence of the recession, and particularly the US recession, before you can embrace a more bond-friendly environment and a more normal cyclical bond rally. I mean, if you look at macro, if you build the macro models on kind of long yields or 5-10-year yields for the US and look at it right now, with inflation where it is, with the labor market where it is, with wage growth where it is, with the Fed where it is, you should expect bond yields actually to be clearly higher than they are today. So let's call it the macro magnet is still for higher yields. So as long as the economy, moves along nicely here, yields should continue to climb. We need to see those clearly higher unemployment numbers, I would suspect, before we get into a more bond-friendly environment.
Yeah. If we look at some of your forward-looking employment models for the US, I know that you've typically used job openings as an early indicator of non-farm payrolls further down the road. What do you make of the job opening gauge right now, given that we've entered a slide from a very, very, very elevated level of job openings? Is it still a feasible indicator to watch?
I guess we will see. I think so, because yes, we entered it with a very high number of job openings, but we also entered it with a very high employment to population ratio in the US. So of course that rhymes. So the starting point is one where we've had a lot more people employed versus the population than historically. So in that sense, even if it's dropping from a high level job openings, it should still have an effect. As far as I can see it, and particularly now when we're also starting to see layoffs actually increase in the challenges statistics or data. I think so too. And what I find very important right now, and which it has historically been as I see it, very important coincident indicator, is that households within the consumer confidence survey now is signaling that it's starting to get harder to get a job. So the so-called job easy versus job hard to get component is now moving in the wrong direction, and that has historically been a very, very strong indication that that unemployment is about to start rising.
If we look at the risk of rising unemployment relative to the equity market, one of the discussions you and I have had over the course of the past year actually is whether the actual timing of rising unemployment is the actual timing of a new sell-off in equity markets. What do you make of that comparison at this juncture? Is it feasible to expect that markets will sell off once unemployment actually kicks in?
Yeah, that would be my guess. I mean, if we go back a bit and look at the bear market that was in 2022, I guess that was, compared to history, the odd bear market, because it happened when the economy was still doing fine, driven by interest rates going up in a way that the equity market had not expected, and it was a valuation story. But if you look at more traditional bear market for the last 25 years or so, they have normally not happened until unemployment has started to move up. So that's true both for the early 2000s setback in the equity market and also the financial crisis. So the key indicator in the past have been rising unemployment. And I think that boils down to two things. The first thing is that it's when unemployment starts increasing, that people will get more worried about the earnings outlook and not just believing that it's going to be a small bump in the road. So I think that's one part of it. The other part is, of course, that as unemployment starts to increasing, that's also when you normally see households taking out money from the equity market, both because they need them, but also to reduce their risk. And that has been a clear pattern in the past. While this year so far, of course, I would say that the retail money has been piling into the equity market. So to me, I still find that if unemployment starts increases in the way that I believe into next year, then I do think that we have one quite clear leg left in this bear market on equities.
If we look at bonds versus equities into such a scenario, Mikael, with bonds not looking optimal at this juncture, given that the inflation outlook is still too hot, and with
you're breaking up, Andreas. I don't know what happened here.
I can still hear you at least, Mikael, but we'll check the sound while I'll walk the audience through a couple of indicators that relates to the discussion that we just had. In terms of the outlook for prices in the U.S., we can bring up chart 9, maybe, Mario, where we have the prices paid by the U.S. big companies in the ISM survey relative to U.S. gasoline prices. And if we look at the gasoline prices lately, obviously, given the spike that we've seen in oil prices, there is a clear possibility that this commodity price spike will spill over to a continued rise in the both prices paid, but also the expectations for selling prices among companies. And I think we've frankly only seen the first signs of that reacceleration in price expectations among companies over the course of the past couple of weeks in surveys. Given what's been ongoing in oil markets, we should probably expect more of the same over the course of the next couple of months until we find an end to this oil price rally. We briefly touched upon it, Mikael and I, this oil price rally and the underlying fundamentals behind it. I can note that the OPEC basically published their monthly report today with updated projections on the oil market supply and demand during the fourth quarter, also given the supply cuts announced by the Saudi Arabian administration just a week ago. And the OPEC report now projects a deficit of 3 million barrels of oil a day throughout the fourth quarter. To me, it looks a tad exaggerated, but it goes without saying that there is a daily deficit in oil markets. And Joe Biden can obviously decide to counter that via the strategic petroleum reserves. But in case he decides to do so, he will quickly run out of ammunition. Say that he will decide to release 1.5 or 2 million barrels a day. It will leave him with no ammunition left in maybe 150 days to 200 days from now, way before the election. So to me, cynically speaking, that sounds like an odd timing. It seems like we have you back, Mikael. I was referring to the OPEC report released earlier today, citing the risk of a 3 million barrel deficit a day in the oil market. And one of the things that we've had questions on over the course of the past weeks here on the platform is whether Joe Biden will be willing to sort of counter that via the strategic petroleum reserve. So do we have any strong views on whether we should expect retaliation from the U.S. administration, given the decisions taken by both the Russians and the Saudi Arabians on supply cuts?
And this is clearly a very tricky question, and it is, I would say, outside of what I usually talk about. So I would say that I don't have an informed view. You probably can get an answer from someone else in a better way than here. So I think I'll stay with that.
Absolutely fair, Michael. Before you lost the connection, I asked the question that I think you struggled to hear on the relative pricing of equities and bonds in a scenario where inflation struggles to get back to 2%, but a recession is around the corner. So if you look at the relative pricing between bonds and equities, with this recession being just around the corner in your base case, what do you make of the relative pricing? What's the best bet if you need to take a bet in either equity or bond space?
I would argue here in the short term, it's probably to buy T-bills, if anything, to be honest. I mean, if you look at the S&P earnings yield right now, it's trading below a US T-bill. And I don't expect the T-bill yield to drop in the foreseeable future. Rather, what we're hearing is the risk they will probably have perhaps even a little bit higher yield going forward, and then stay at those levels for quite a long time. And of course, with my recession scenario for the US and thereby an extremely low risk premium in equity market, I would sort of take that risk-free alternative. I mean, looking at if you calculate the equity risk premium for the S&P 500 and then looking at US 10-year yields as the comparison point and 12-month forward PE, it's now down to about 1 percentage point. Normally, it used to be around between 3 and 4. In recessions, we've seen it spiking to 6. So it's a very, very low risk premium ex ante, even in a quite benign scenario. And I would much rather put my money in the risk-free option thereby. Comparing it to bonds is a little bit trickier because, of course, what I'm saying is that there is a risk that bond yields continue to climb a little bit here, i.e. that you will lose a little bit more. But then I'm clearly in the camp saying that the next larger move in the bond market will be towards lower government bond yields. But for now, I think I would be happy to take those, T-bill yields.
Michael, if we look at equities on a sector by sector basis, we mentioned in the intro that technology could be an odd performer in this environment. At least it has been throughout this year, given the sort of competitiveness and the market power of these mega tech stocks. Do you have any preferences in terms of equity sectors, equity styles that will perform better than others in this kind of environment?
I think what we have been advising our clients into this year has been that, given that we have a view of an earnings recession and an earnings recession that will be with us for longer than the analysts have been indicating, and of course now with the no landing scenario that many has, that basically analysts are saying that is over now. What we've been saying is that what you should look at is not so much sectors and things like that, but normally what performs during that type of environment is what we would call quality stocks. And what are quality stocks? Well, there are a number of quality traits, but the two that usually sticks out are companies with a very strong free cash flow yield, and companies that has shown stability when it comes to return on capital employed. Those types of companies are the companies that historically during recessions have been the ones that have been performing. And even though it's been a quite odd equity market this year, with more equally weighted indices basically treading water since January, and I guess the Nordic index, for instance, is basically down actually since early December. Quality stocks have been a place to hide. If you take the MSCI quality definition, there's been a clear outperformance of quality stocks compared to the market. And also you can see in the Nordics that quality stocks have performed a little bit better than the market, not much. But clearly, if you have avoided sort of the bottom companies in terms of quality, then you would have done very well as well. So I continue to point to the fact that if we are right that this earnings recession that analysts now are assuming is over, that we will have more legs to the downside into 2024, then it's quality you should look for.
If we look at this discussion on the cyclical component of the US economy relative to the stickier component in services, do you find any value in the spread between cyclical equities and non-cyclical equities given this discussion, Michael?
Yeah, clearly, and of course, what we've seen now is that cyclicals have fared a lot better for a while, and then defensives in the US and also globally, which rhymes with the fact that at least up until now, GDP numbers and labor market numbers are indicating that we aren't in a recession. But of course, in my scenario, looking ahead like 6-9 months, then we should come back to a period where sectors of more defensive characters should outperform. That's usually what happens up until the day that the authorities turn around fully and go all in terms of stimulus, and then everything turns around. But clearly, in all previous recessions, you should have hidden in more defensive sectors, and we're simply not there yet. But I think that would also be something that worked very well during the bear market in 2022. I think it will work very well if we go back to a more cyclical recessionary bear market.
Mikael, in relation to this discussion on whether and when authorities will go all in to counter this recession scenario, our CEO Raul spoke about it yesterday, that ultimately it is very hard to imagine a scenario where authorities will not backstop asset prices, given the level of debt globally and all that. What do you make of, say, the potential for QE over the next 12 to 24 months, given that we have these struggles of bringing inflation back to target? Is it a game changer for global central banks? Could we actually face a recessionary environment in assets without them going all in saving assets?
Oh, I have no illusions here. So, I would guess that if they once upon a time have decided that QE is a good thing, they could definitely push that button again. That I agree with fully. However, I would assume that they wouldn't want to do that as long as they feel that inflation is a true problem. And for me, that means that it should take longer before any such decisions than it has been the case since the financial crisis, because of course now we're seeing potentially at least the dark side of QE. And I guess particularly the dark side of QE combined with fiscal policy measures. So it should take longer this time, in my sense. And I also have the feeling that central banks, it should be a lot less willing to push down real yields into very negative territory again.
And pardon my French here, Mikael, but you're a bit older than I am, and you probably have a bit of experience from markets where fiscal policy played a bigger role in defining asset prices and economic trends. So is it a game changer that fiscal policy is back as a tool in the toolbox for both the US administration, but also for the European administrations with bigger deficits than what we're used to?
Yeah, game changer. I mean, clearly they've at least now, and that also showed itself during the kind of energy crisis that we had last year, that it's getting easier to push through those stimulus packages than it perhaps was for a long period, despite the fact that debts are already very, very high. And what the end game in that is, I don't have a clue, but clearly, and they also had this kind of course, odd cycle where basically the debt is kind of financed through their own central banks, which you can feel is perhaps not the best way of doing it if you want to get the long-term, the long-term trends in a better shape. But yes, I think we saw it when energy prices spiked, that they're willing to go in with also in Europe with various packages to help that out. And of course, we have the Inflation Reduction Act in the US now and so on. So it's probably part of the picture. And right now, of course, interest rates haven't shot up massively. So that we have some inflation now, as long as bond yields do not spike further here, of course, it kind of inflates away some of the debt. But here, clearly, the risk is, of course, that the bond market at some point will say that now enough is enough. And if bond yields start spiking more viciously, then this trick will end in tears in terms of sort of fiscal policy as one of a more active measure to counter stuff.
Mikael, I'll allow you to conclude on how you see the recession risks being priced in across assets and geographies before we bring Maggie back for the Q&A session as the last part of this show for the hour here. So, Mikael, where is the recession priced in? Where is it not priced in a few words?
Well, I guess it's starting to get priced in Swedish real estate. We can start there. That slumped massively last year, and clearly, has seen the recession happening as well. So that would be one where it is priced in. Otherwise, I don't think it is that much priced in, more or less anywhere, in a sense. You could claim it's partly priced in Europe with valuation levels a lot lower than for instance, in the US. But still, if you would calculate an equity risk premium and also in Europe, it's still very low for a recession scenario. So I would say it's not priced in. And then if you then turn to sort of the corporate bond market, I mean, right now, if you have an investment grade 10-year bond on the corporate side in the US, it's trading basically in line with the T-bill yield. So you don't really get paid to take on any risk there as well. And spreads have of course tightened also in the high yield space. So it's very difficult to say that there are any recession scenario discounted there. And of course, we talked about the US market and what normally happens, and that is that risk premiums tend to spike between 3 and 4 percentage points in recessions. And currently they are at the cyclical low, so they haven't even increased at all. So that is also why I would prefer to stay very, very boring and buy T-bills, sorry.
Maggie, I know that you've been tracking the chats and commentary sections for questions. So anything that pops up as the question of the hour here?
Yeah, I think so. We've got an issue that's sort of been lurking in the background in terms of risks. By the way, fascinating conversation. I think the timing of this recession has just been so difficult. So so great charts on that. Kyle asking, could it be that CRE, commercial real estate, hasn't repriced due to the lack of liquidity and the sector is holding on till the Fed cuts rates? But what happens if the dot plots start moving for 24 higher due to energy? So this issue of that maybe being delayed, what you see coming, Mikael, how long can CRE funds gate redemptions?
No, I mean, that's a $1 billion question, of course, even more than that, I would assume. I mean, we can make the analogy with Sweden, which of course has had borrowing much shorter on the yield curve in a sense. And what we see here, of course, is that for a while, yes, things will keep together, but the longer the period is with high interest rates, you will have to roll your debt, and you will end up in problems. And of course, that is true for the CRE market in the US as well. And at this juncture, at least I don't interpret the Fed as being that worried about it, which tells me that there could be a period, exactly what you described, that they push up the dot plots because of inflation trends, and then at some point, that you need to roll your debt, and then you get into problem, and it could become clearly a much bigger issue than it is today. Then I'm no CRE expert in the US, but we can see what's been happening and going on in the Swedish market and what's now going on in Germany, which could be a little bit of a leading indicator of what could happen in the US.
Andreas, do you have any thoughts on that?
So I perfectly agree with Mikael that everything that we see trend-wise in Sweden and Germany right now will likely arrive in the US with a time lag due to the differences in the duration of interest rate hedges of CRE companies in the US relative to Sweden, for example. I've worked for the second biggest asset manager within the real estate space in Europe until a year ago or so. And it is my impression that the typical interest rate coverage is so So the amount of cash flow that you generate as a CRE company relative to the interest rate payments will approach that ratio throughout the course of 2024 without rate cuts in Germany and Sweden on a sector basis, meaning that they will only generate the exact cash flows to pay interest rates. Good luck paying your employees after that, right? So it is a big mess if we do not get rate cuts in Europe for this sector. And ultimately, this will arrive with probably an 18 to 24 months time lag in the US due to longer duration profiles and honestly much more prudent risk management within CRE companies in the US relative to Sweden. So yes, actually CRE companies have been much more prudent than European peers ahead of this interest rate hike.
Michael, it brings up a good point, though. I think that the sort of behind that question is, if you think there's a deeper recession coming, it's just taking longer to get here. Does it break something, right? Is it the labor market that has to break? I mean, he's there asking, is commercial real estate going to break? That's kind of what everyone's looking for. What craters? And then does that bring central banks in? That's the tricky part.
Yeah, and it is clearly a very important question. Again, comparing to Sweden, I guess what we're seeing here is that the real estate side of things are cracking clearly. However, it hasn't had so far any broader consequences for the whole economy. And at this point, the central bank or the Riksbank is very it's not that worried about it. And I guess that comes back to that what we're seeing is, of course, that real estate companies are moving more into bank financing. And banks, I would say generally speaking, in Sweden and for that matter in the US, of course, they have a lot better balance sheets today than they had ahead of the financial crisis, and can cope with it in another way. I think that's one part of why it's not so worrying right now. And even though that I sort of come across as very gloomy here, I understand that, and I'm happy to be that. I'm not foreseeing a sort of a financial crisis type of scenario. To me, this is more of I've called it a speed bump recession, in terms of when you hike interest rates as fast as you've been doing, something will give in terms of the cycle at some point. Now that timing is, as you say, very difficult. But if you look at, once again, the normal patterns between monetary tightening and the economy, it should occur. The worst part of it should be towards the middle of next year, and a little bit later than that. But as I said, to me, this is not the financial crisis 2.0. It's more of a regular recession, but with the added problem that risk premiums in large parts of the asset market is very low, and I doubt that they will be able to swallow even a normal recession.
That's a great point. And so Joseph asking, I know you talked about hiding in T-bills, given this outlook. Joseph asking, do you have a forecast for gold? How do you feel about gold?
That's a typical Andreas question.
I see Andreas laughing, by the way. He's been sneaking in the chat as Joseph. No, he was too busy.
I'm always long gold to a certain extent, but not by a large percentage of my portfolio. And I've actually scaled down a bit on gold over the course of this year due to the, I think, lack of transparency on when we will get financial repression back from central banks. Gold likes an environment of low interest rates and high inflation, but gold does not necessarily like an environment of high interest rates and high inflation. So it matters whether central banks will continue to hike or not for this gold case. But if we're going to sniff out an early move towards some sort of orchestrated, coordinated pause from central banks across the globe, then you better get your gold longs ready. But I'm not there yet, but I'm getting there, I'd say.
Michael, what about you?
No, I think Andreas has a very good point here. Given that real rates have been going up quite significantly, and I talk about expected long-term real rates, not in the short run of the yield curve. Normally, you would have expected gold to do a lot worse than it has, and I guess that comes down to partly what Andreas is saying, that as long as inflation is high, people still see it as an inflation hedge. And I guess secondly, that there are still a lot of people out there, guess me included, seeing that what sort of the end game of all this should be some sort of crash for assets. And then you're often very, very, then gold is somewhere to hide as well. But of course, if we are in a situation where real yields continue to climb and stay high, at some point that would probably be problematic for gold. But here and now, given my more gloomy view on the economy and gloomy view on it's kind of a stagflationary idea that I have, then I guess gold would probably be fine.
Yeah. So, and that's exactly what I'm walking away from this, Andreas. I'd love to get your thoughts. It does sound like you do see an economic downturn. You're looking at Sweden and some of the early signs in Europe. It's just lagged to get here in the US, but inflation's a problem in the near term. Those prices being sticky are going to keep the Fed with rates higher for longer, and that's going to be a problem. And neither stocks or bonds look like a good place. It's too early for the bond move, so you've got to hide in the short end in T-bills to try to get that return. Does that match up with your thoughts? And Andreas, what are your takeaways from this conversation?
I guess the main takeaway is that a payroll recession is still very likely in the US. So the 80% of the economy related to the service sector will likely struggle into next year as a consequence of rising input costs from labor relative to what they're able to get for their products. If we look at historical recessions, we've often seen how the price of labor has sort of outpaced the overall price inflation during inflection points. And it is exactly what Mikael is alluding to here, that wage growth is too high and the cost base will likely drag down the labor market into next year. And I perfectly concur with that view. If you want to find pockets of strength in this kind of economy, take a look at how sales to employee ratios have boomed for the energy sector. They're making a truckload of money and they have no employees. That's essentially exactly what you want to invest in into next year, in my opinion.
Mikael, any closing thoughts from you?
I think as a final comment, it is, to me, still the big problem with markets is kind of a risk premium problem, and entering a cyclical downturn, it's never a good idea usually to own assets with a very, very low risk premium, and I see a low risk premium basically both in the equity market and in corporate bonds, and even in a more benign scenario, a risk premium will still look very, very low.
Gentlemen, thank you both. Fantastic conversation. You couldn't have named your research paper better. The plot thickens indeed. Yeah, we're going to have to steal that all week, Mikael. Thank you. Thank you both.
Yeah,
thank you.
Thank you.
Listen, keep the conversation going. We're reading all the comments. It's been fantastic. Next up in the series, I'm going to sit down with David Rosenberg and Lizanne Sanders. It's going to be super interesting to get their view on what's ahead. David Rosenberg has sort of believed we're already in recession, so super interested to get an update on that from him. That's happening at 11 a.m. Eastern on Wednesday. And of course, we'll be back at 4 p.m. today with the daily briefing. We hope to see you all then. Thanks so much.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.